Hey traders, Raghee here. Welcome to another episode of Charts and Coffee. Happy Friday, everybody. Pretty wonky week considering we've had two giant juggernaut of stocks that have released earnings and absolutely nailed them 60 feet over the fence. And we wake up to a morning where the NASDAQ is having some trouble with some footing. Really interesting here. I talked about this in the free video last night over at the Simpler Trading YouTube channel as to what we need to watch for. And I am right now looking at some different seasonal factors. No, not that, not YouTube. There we go. Some seasonal factors that I've got on my radar right now. In terms of, no, where is it? There we go. In terms of right now, what it is that I should, from a seasonality perspective, expect. We're in the sell May and go away. Am I always thinking about seasonals? No, really more so on the commodity side of things. That's where seasonals really have, that's where they began. That's where they're most applicable. But as we go into May, we got to think about probably the second most popular sort of seasonal saying that's out there. Only after, I'd say, Santa rallies, we've got sell May and go away. And so I'm really looking at whether or not that's something that is true, we can capitalize on, what's the tendency. So those are some of the things that I'm looking at right now on the sector secret side of things at the moment. The other thing that I'm looking at is all-time highs. If you haven't thought about the relevance of sector rotation, what's leading, what's lagging, and how could, and imagine a Ferris wheel, how could that Ferris wheel turn and sort of put another group of folks at the top of the wheel? Now's the time to think a little bit about some of those sector rotation factors, okay? So I hope you guys are having a good week. It's been an interesting one, to say the least. And let's get to your questions, as always. All right, great to have you here, gang. All right, let's get into it. We've got, let's see, Lyft. Oh, gosh. Yeah, straight up. Lyft is a frustrating one for me because what I've been doing is I have not been looking at sort of consensus names, consensus trends. And Lyft was one of the names that was within, gosh, that high right there was 64. That was 26 cents. I think it was 26 cents from our first target. So we were moving up towards that range. I was looking for the market to make a run towards, an even number where we've seen resistance before, some volume levels. And then look, the market can move because of technicals. Market can move because of news, and the market can move, really there's only a few avenues of potential movement. This was news. We heard that we're right back to that merry-go-round. This is Uber and Lyft's sort of nightmare scenario, right back to gig economy workers. Are they employees or not? And both Uber and Lyft were just unceremoniously dumped. I wouldn't call this really a technical move. Frustrating for sure, because I think this has been a pretty decent performer. Definitely not one of the better names on my book, even absent of yesterday's price action. But this is what news does. It says, I don't want to go back and say, well, the technicals, this was news. This was news. And so really tough right now. So the question a lot of folks are asking me is, does Lyft get faded on this news? It might take a session or two for Lyft to sort of gain its footing. But this is one of those potential news that could become fact that really, really could absolutely annihilate Uber and Lyft. If for whatever reason in the US, I think the labor secretary said something about bringing back this gig economy workers versus the employee conversation. This is a dangerous one. I would leave Lyft alone. If you've got an open trade as I do, manage it to your risk parameters. We have set risk parameters in sector secrets. In other words, the moment you're in a trade, you're already crunching the market money math that I teach you. You know what your risk is from the moment you hit buy and get your fill. Just follow that. And I think most of you probably ended up saying thanks but no thanks on the way down. Check, please. We're gone. we're gone. I would not just arbitrarily fade this, because this isn't just a miss in earnings or revenue. This isn't just some sort of CEO reshuffling or something like that. This, I would say, steer clear just for a little while. Generally speaking, I'd say yes, it could be faded. But gang, let's not play chicken with the train on this one. Okay, so I hope I'm really clear on that one. Roku, and again, I have to reiterate, I love telling this story because it really talks about everyone. What's the holy grail to trading, right? What's the holy grail? It's really simple. When hedgies get together, and you've probably seen this in those different conferences where all the hedgies come into town and they ask each other questions, they interview each other. They're actually really interesting interviews. They will always start up with some softball pitches and ask each other about, what they see in the economy, maybe what their macro view is, if they're more macro type analysts. They might talk about different sectors. They usually steer clear of, what are you trading? Because they all can look at the filings. It's the filing weekend to see what their holdings are. Inevitably, what they're doing is very slowly warming them up to what the one question is that hedgies always have for each other, but no, they'll never get answered. Position sizing. We make position sizing and risk management the number one thing in terms of the market money math of never build a position based on where the market could go, not even necessarily based on what it costs. Everything we do is based on what happens if you're wrong. Can I afford to be wrong in this trade? And if you start with that as the main reason for how and when, what position size you're going to execute at different levels within the valid area of entry, you're going to have a different level of confidence sleeping at night because, give or take, alien ships hovering over Manhattan, you've got your risk side covered. That's the way you sleep at night, gang. That's the way you manage trades. So anyways, again, when hedgies, the best get together, they don't care. Are you deploying this kind of strategy or using this kind of indicator? They ask each other about position size. All right, Roku. Roku could actually be setting up really nicely for a potential squeeze and 1, 2, 3. So one of the things that's in play here is a 1, 2, 3 continuation, because the previous trend was up, very choppy, but inside all this chop, we've got a 1, 2, 3 forming, which actually is going to trigger as we break the major psychological level of 400. But I think in the middle of all this, we actually have a nice series of blue grab candles. That kind of compression is really a great precursor to a momentum breakout. Be aware of earnings and things like that in terms of aftermath and precursors too. But technically speaking, I would be looking for a breakout and in the direction of the previous trend. That's my opinion on Roku. I'd be bullish, but where are you getting long from? The closer you can get long from, say, 350 to 340 would be fine. That would be front running the 1, 2, 3 completion. But your momentum is probably waiting north of 380 and then really north of 400, which, by the way, both of those are psychological levels, one minor, one major. All right, next question is, can I comment on the gap psychology in the S&P yesterday? Sure. So, this actually is a great question. And again, what this takes us back to was yesterday a broad-based sell-off? And if you check out the free video that's at the Simpler Trading YouTube channel, I talked about and showed you why it was absolutely not. This was not one of those watershed sell everything moments. This was high concentration weighting at work. High concentration weighting is great when the top 6 names of the market, and what are we talking about? Apple, Microsoft, Amazon, Facebook, the Googles, and Tesla. Those names are heavily weighted within the S&P and the NAS. Now, if you haven't looked at the weighting, the construction of the indices and the ETFs that you're trading, and if you don't know if you've got a high concentration weighted investment portfolio trading book, you're really in a tricky scenario where if the markets decide to roll over and you're highly concentrated in certain ETFs where you don't realize the overlap. For example, if you're in XLY and you're in QQQ, your overlap is Amazon and Facebook. got to know these things. And so when those are working, that's a great way to sort of double up with a little bit of an ability not to just pile into a single symbol or a single ETF. You can sort of disperse your capital across two different ideas with a high concentration weighting, and Amazon and Facebook. So when it comes to the S&P, what does it have to do with the S&P and gap psychology? Yesterday, if we don't open both above the previous session's close and high, which we did not yesterday. Yesterday, you can see that there's the candle that preceded on a 428, there's 429. That was not gap psychology. That was not the kind of session where I would step back. Sorry, there's the 29th and here's the 30th, by the way. So the gap psychology starts with the session before. Now, if I'm not trading above both those levels, and we'll talk about the NASDAQ as well, we have to when it comes to the S&P, because the S&P is always in sort of a tug of war between the NASDAQ and the Dow. The S&P is not the captain of its own ship. So if I don't open above both, then I don't have what's known as a dual confirmation gap. Okay, so that's the way in which I measure gap psychology. Is a little bit different. What are my thoughts on IWM and small cap stocks? You know, I think IWM and RTY, the Russell future side of this conversation, a lot of folks are watching it. I was actually just talking to, and I'm sure those of you that are in the futures room and in the options room and even in the Sector Secrets Mastery are familiar with Lorna. So Lorna and I were talking about the Russell, and I don't know if Lorna's in here or not, but this is exactly what I told Lorna. And I'm going to look back at our Slack conversation, but I said I wanted to pull back like this before we bought it. In other words, I want a 1, 2, 3 pull back. And I think we talked about 2260 to 2255 as a zone. So you get the boom, 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 breakout, retracement. We're in that zone right now. I'm actually now quite interested in a long position in RTY. That's the futures version. IWM, that's the ETF version. Or keep this one in mind too, KRE, regional banks. I would actually keep an eye on the regional banks as well. It's an outperformer within this IWM RTY conversation. Keep an eye on regional banks. Whenever you're thinking, hey, I'd really like to buy IWM, make sure you're looking at some of the KRE, this regional bank narrative, because, gang, yesterday, XLF said, what sell off? This was not a broad-based risk aversion. This was Apple and Microsoft getting Donkey Kong. This was the XLK, and this was not a broad-based sell-off. So I think a lot of folks, I got a lot of emails about bonds yesterday. You know, is it the yield 10-year? Is it the 30-year? Is it those yields that are causing so much problems? Gang, the NASDAQ was still pushing at lows when the bonds were coming off their lows. This was not a, oh my gosh, the 10-year has hit a brand new high on yield kind of conversation. Not at all. Because you saw the disconnect. I'll show you the 10-year here. You saw the disconnect. So both of these are up. So don't go blaming bonds, gang. Don't go blaming the Fed. Blame traders and investors who moved the markets and decided that Apple's blowout earnings was a reason to fade the market. And I mentioned to my Sector Secrets folks yesterday, so gang, you think people are going to abandon Apple because Goldman doesn't like them or whatever such nonsense? Whenever Apple comes out with earnings, there's all the naysayers. I'm not an Apple fangirl, but what I am going to say is every year we say, gosh, Apple's not really doing anything new. They're just selling phones, but they sell a lot of them. You know, yes, Apple is sort of this consumer electronic company, luxury consumer electronic company that happens to have this sort of cloud service and happens to sell some music and happens to have some other hardware they sell. Gang, they sell a lot of these. And so there's always the naysayers that come out. One of our calls yesterday was let's step in and buy some XLK. It's an affordable way to scoop up Apple and Microsoft simultaneously much more affordably. And those are the kind of things that I love to do. That was one of the setups we said we looked at grabbing that XLK sort of at peak ridiculousness. So when we go back into the conversation about Microsoft, and I see that question is there. I love the question. Love it. Does anybody think, and back, this was so Lauren and I talked about that pullback in the Russell. I like that KRE. We talked about that pullback in XLK and the sector secrets. So yesterday we're getting ready for the next episode or issue of Countdown Trader. My partner here in the office, Trish, said, "Hey, Rog," and it was so funny because I was thinking about it, looking at Microsoft because we just set up something for XLK. And she said, let's talk about what happens after earnings. You've been really clear about the 642, and Trish has written up my 642 earnings approach, which I've been using for decades. Really simple, trend following approach. And she said, well, what happens after earnings? And I said, it's so funny you asked that, because we just focused on Microsoft and even Apple, both of which still have double green. This is where you can, sort of get better bang for your buck by going with XLK. Microsoft after earnings pull back into the wave. I love that. I love that. The volatility and volume, intensity of the earnings release culminated into, voila, a wave retracement. And so, yeah, I like that one a lot. Is it a little riskier? Of course, because the challenge is by not waiting for an inside day, by not waiting for a minor low, but here's what's really interesting. And, this is a cool precursor to something that we'll be doing in June. So for those of you that have been sort of thinking, all right, maybe it's time to start looking at some short term as we go into May. We know May volume, May through summer, Memorial Day to about Labor Day, volume could be the way that it could be. It's really actually a pretty good time for some day trading. My day traders, who are also swing traders, those of you that have both those skills, and I'm so grateful that I spent 7 years day trading, because understanding order flow and thinking like a day trader on days like yesterday, even though your time frame and your time horizon is longer, you're going to see things that someone who's just looking at sort of this lifeless daily candle is not going to see. You're going to see the nuance of the shorter term time frames that are actually all packed into that one big daily candle. And so that's where some of the day trading knowledge is going to be very helpful, where you look inside the wave and say, what's really happening in that wick? What's really happening around 250? And if you kind of put your day trading hat on for a moment, even though you're swing trading, you're going to find being able to sort of flip that switch, it's going to give you a whole lot of advantage, even in your longer term trading. And that was really at work yesterday. I looked at some shorter term timeframes and said, am I seeing something that's telling me we're seeing a shift? So yeah, intraday short term patterns are going to help me find opportunities longer term. So I like that. I like that Microsoft and where's that question there? Yeah, I like that Microsoft and XLK and Apple set up a lot. We have Amazon, the aftermath of Amazon. Just when we thought Apple had a huge 60-foot over the fence home run, Amazon says, as they say, hold my beer. And I mean, and very similar type fade. Watching the Asian session last night, they were not impressed when the bell rang in Tokyo to sort of start off that Asian session. And so we'll see how the markets respond to that right now. So tech, editor HKT, if you know, I've been playing the fringes around tech, Qualcomm. We've been looking at some cloud computing, CLOU. What else have we been playing? Canada. We played EWC, and we're playing the Canadian dollar, and we're playing uranium, and we're playing oil stocks. So I don't want to put a lot of emphasis here until after this week. This is the most impactful week of earnings. But next week, I'll be very interested in, how the dust settles. I think it's absolutely ridiculous for the market to think that with the kind of earnings and the Federal Reserve still firmly in asset, they're willing to continue to increase the purchases, increase the money supply, increase the purchases, the asset purchases. They're willing to absolutely continue to expand the balance sheet. Very tough to want to bet against stocks, but we just can't blindly go in and buy the broader averages right now or the heavily weighted stocks. I think what we want to do is look at the relative. We always want to do this. We have to look at the relative outperformers within these sectors and ask ourselves, do I like Apple and Microsoft? Do I like Amazon? Or do I like some of the stocks that are a little bit lower weighted or in semiconductors or cloud computing or software, right? So look below the tip of the iceberg, get underwater and see what else is happening that's not quite surface and obvious level. And I think you're going to find a lot more success there. All right, so let's see here. The Darvis is automated. The Darvis tool is automated. It's a free tool that we make available, and that's automated. It's a sort of reimagining of what Darvis can and is. It's not a strict interpretation. I'm a huge fan of Nicholas Darvis. I've got a lot of his old books. I'm actually looking back on my bookshelf back there. I've got two bookshelves. Yeah, we got the monster bookshelf, and I got another little one over here. That's out of the camera. But yeah, I'm a huge Darvis fan, but I think his 52-week breakout box approach is limited in today's environment. Still applicable, but can we still use minor highs, minor lows, and the candle count, which was really the gist of the Darvis box itself, to sort of reimagine and modernize it, which is why I pay homage to where the ideas came from, Darvis, but it's 2.0. So that's really what we do there. That's what we do there. Gang, just like that, our 20 minutes is up. Hey, Bob, thank you for the shout out. We did the ultimate day trading class last year, and that focused on futures and my day trading futures. Really about 4 to 6 markets, and we had so much great feedback, and a lot of people saying, "Rag, we want what's next. How do you do it with ETFs and options and currencies? What's the next?" What are the nuances now that even since that class, what are the things that we can do in this market? Because it's very different than last year's market. So if you guys are ready for, the next level of the day trading, that's coming up in June. And we're really stoked. Trish and I are working on that already. We've been, really working on that the last few months and looking at what the things are that you guys have been asking us about since that class, which was my biggest class. A lot of people said, yeah, we want to do that 2-hour thing. How do we use the V-score? How do we do that in other markets? So yeah, really exciting. And the biggest request was, we want to day trade the options. Futures are great. We get that, Rog. You've been a futures trader since you were 15 and a half. But what about day trading Apple yesterday? How do I do that? So anyway, really excited for that. You guys will get information on that eventually. But yeah, I appreciate that, Bob. I loved doing that class. We had a great, awesome group in that. And I think a lot of you really run with that and made so much of that approach your own, making it fit your life. 2 hours a day. You can't beat it. All right, gang. So enjoy the rest of your Friday. Heads up. I'm not bearish this market, gang. These are retracements. I'm not bearish at all. I'm not picking a top. I'm not hedging. I am going to do what Powell basically told us to do, which is buy, right? As I joked yesterday in the free video, the only thing that Powell didn't tell us on Wednesday was whatever his S&P target is. All right, gang, don't fight the Fed. All right, bonds may be right eventually, but they're always going to be right in hindsight later. They can be wrong for a really long time. So don't overdo it on blaming bonds yesterday, gang. It wasn't about bonds. I explained it a lot in the free video. Check it out. Leave a comment or a question. We check them. We answer them. A lot of you realize we actually answer them in little videos. So let me know if you have a question or a topic request or something along those lines. In the meanwhile, I'll see you all on Monday. All right, gang. Be good to each other. Enjoy your weekend. I'll talk with you soon.